LiteFinance, the world of financial freedom.
Hello guys, it's Monday, February 6th, and so it is time to start the market forecast, where of course we will summarize what is going on the macro calendar, and then we will do a more broad yet detailed fundamental analysis, based on which at the end we will make a plan for trading on Euro USD. Okay, so at the start I have to say that this week does not come close to the previous one in terms of macro data publications. On Monday, nothing really happens. On Tuesday, also one thing that can be interesting to watch is a discussion with Jerome Powell at some economic club in Washington. On Wednesday, we have crude oil inventories. On Thursday, initial jobless claims from the US and EU leaders summit. And finally, on Friday, GDP data publication from the UK. And basically, that's it as for the calendar. As I said, not much to observe. Okay, now let's summarize the situation on the markets after the previous week with the central banks and their rate hikes and a very strong NFP reading. So, the mighty dollar is back. A rise in employment by 517,000, a drop in unemployment to a 53-year low, and an increase in the average working week make the recession impossible. The US economy may accelerate again, and the stock indexes may perform better than their foreign counterparts. If so, then the risks of Euro-USD correction are growing. The return of the weakened US dollar to the game could be its swan song against the backdrop of exiting USD short trades. Over the past 7 weeks, hedge funds have been adding up to USD short trades, so a bounce up from here serves as the path of least resistance. On the other hand, Euro-USD's fall is based on fundamentals. The USD's 4-month decline was associated with losing its main advantages. Now they can support it again. If the labor market is so strong that the employment is booming, a number of job openings are skyrocketing, and unemployment benefits are declining, then the markets may once again come back to the topic of American exceptionalism. The combination of slower inflation and strong consumer sentiment is even better than the Goldilocks regime. Costs are down and profits are up. The US stock market may once again outperform foreign counterparts, while capital repatriation is great news for Euro-USD bears. Strong employment data has raised the possibility of a 5.25% increase in the federal funds rate from 30 to over 61%. If inflation rises again amid a strong economy, the Fed is more likely to increase borrowing costs after the pause than cut them. The chances of Fed's dovish reversal are failing, so the US dollar is strengthening. Finally, an increase in US-China tensions could bring back the interest in the USD as a safe haven currency. Thus, all three advantages that allowed the USD index to reach a 20-year high in the autumn of 2022 are back. It's American exceptionalism, a more aggressive Fed, and rising demand for safe havens. The question is, are they temporary or the last year's trend returning? Well, plus 507,000 looks abnormal. It is unlikely that it will continue to increase at the same pace. However, the idea of a return of a high inflation in a strong economy deserves attention. It looks like the market are too focused on the dovish reversal and have already believed in their victory over the Fed. Perhaps they will be able to fight the central bank, but they are unlikely to fight the factors. It is worth paying attention to the fact that the Euro-USD's inability soon to return above 108.25 and 108.60 increase the risk of a correction, which means basically that if we don't manage to get back at those levels, shorts should be the best option. Okay, that would be all guys for today. Thank you for watching and goodbye.